In this session, we're going to break down one of the most important financial statements in financial reporting, the statement of cash flows. By the end of this session, you should be able to understand the purpose of the statement of cash flows, clearly distinguish between profit and cash, prepare and interpret cash flows using both the direct and indirect methods, correctly classify cash flows into operating, investing, and financing activities. Now here's the key idea to understand from the beginning. If profit tells us about performance, cash flow tells us about actual cash availability, liquidity, and solvency. A company can report strong profit and still face serious financial trouble because profit is calculated using accrual accounting. That means revenue can be recognized before cash is received, and expenses can be incurred and recorded before cash is paid. It also includes non-cash items like depreciation. Cash flow, however, only records real cash movements, money coming in and money going out, and this difference is critical. Many businesses fail not because they are unprofitable, but because they run out of cash. They cannot pay suppliers, employees, lenders, or tax authorities, even if their income statement looks healthy. That is why the statement of cash flows exists. It connects accounting performance to financial reality. Now that we understand why profit is not the same as cash, let's look at how the statement of cash flows is structured. First, we have operating activities. This section shows the cash generated from the company's core business operations. It includes cash received from customers, cash paid to suppliers, cash paid for wages, cash paid for operating expenses, cash paid for taxes and interest. A healthy company must generate positive operating cash flow consistently, because operations are what keep the business alive. Second, we have investing activities. This section shows how the company invests in its future. Examples are purchase of equipment or machinery, purchase of buildings, purchase of intangible assets, buying or selling investments, selling fixed assets. If this section is negative, that is not necessarily bad. It often means the company is investing in growth. But if a company keeps selling assets just to survive, that could be a warning sign. Finally, we have financing activities. This shows how the company raises capital and how it repays capital. Examples are issuing shares, borrowing money, repaying loans, paying dividends. Now that we understand the three sections of the statement of cash flows, operating, investing, and financing, we're going to look at the two ways they can be presented, the direct method and the indirect method. Both methods calculate the same number. The difference is how we get there. The direct method starts with actual cash received and cash paid. The indirect method starts with profit and then adjusts for non-cash items and working capital changes. In the end, we arrive at the same cash flow, just via a different route. Now let's move from theory to practice and prepare a full statement of cash flows using the indirect method. Let's assume our income statement shows revenue 500, cost of goods sold 300, operating expenses 100, depreciation 40, interest expense 10, tax expense 20, net profit 30. Balance sheet changes. During the year, accounts receivable increased by 50, inventory increased by 20, accounts payable increased by 30, plant property equipment increased from 200 to 300, depreciation during year is 40, loan increased from 100 to 150, interest paid is 10, tax paid is 15, dividends paid is 5. Under the indirect method, we always start with net profit. Net profit is 30. Depreciation reduces profit but does not reduce cash, so we add it back. Depreciation is plus 40. Now we adjust for working capital movements. Accounts receivable increased by 50. If receivables increase, it means we made sales but haven't received the cash yet, so we subtract 50. Accounts payable increased by 30. If payables increase, we haven't paid suppliers yet, so we saved cash. We add 30. Inventory increased by 20. Inventory increase means we bought more goods than we sold, so cash left the business. We subtract 20. Interest paid is 10, and tax paid is 15. Notice, the company made 30 profit, but only generated 5 in operating cash. That's because cash is tied up in receivables and inventory. Investing activities relate to long-term assets like plant, property and equipment. Plant, property and equipment movement is: opening balance is 200, closing balance is 300, depreciation was 40. We use T-account logic. Plant, property and equipment purchase equals closing balance 300 minus opening balance 200 plus depreciation 40. Cash used to buy PPE is 140. Financing activities relate to long-term funding. Loan increased from 100 to 150, so company borrowed extra 50. Dividends paid is 5. Net financing cash flow is 45. Final cash movement is operating plus 5, investing minus 140, financing is plus 45. Net change in cash is 5 minus 140 plus 45 equals minus 90. This means cash decreased by 90 during the year. If opening cash was 120, 120 minus 90 equals 30. 30 is closing cash. This company is generating very weak operating cash flow, only 5, but is heavily investing in plant, property and equipment. It's financed mostly by taking additional loans. This could create liquidity pressure if operating performance does not improve. Now we are preparing the statement of cash flows using the direct method. Under the direct method, we calculate the actual cash received and the actual cash paid during the year. We begin with cash flows from operating activities, which relate to the day-to-day business operations. Revenue in the income statement is 1,000. However, accounts receivable increased by 100. This means we did not collect all of our sales in cash. So, 1,000 minus 100 equals 900. Therefore, the company actually received 900 in cash from customers. Cost of sales is 600. Accounts payable increased by 50. An increase in payables means we have not yet paid some suppliers. So, 600 minus 50 equals 550. Therefore, cash paid to suppliers is 550. Operating expenses are 200, and we are not told about any accrual changes. So we assume they were fully paid in cash. Cash outflow is 200. Interest paid is 50. Interest paid is usually classified as an operating activity. Tax expense in the income statement is 30, but tax paid is only 20. So we deduct the actual cash paid. So although profit was 120, the company generated only 80 in operating cash. The difference is mainly due to the increase in receivables. Investing activities relate to long-term assets. Plant, property and equipment purchase is 300. The company purchased equipment costing 300. This is a cash outflow. Net cash used in investing activities is 300. Financing activities relate to how the company is funded. The company borrowed 200 but paid 40 in dividends, so net financing inflow is 160. Final reconciliation. Cash flows from operating activities is 80, from investing activities is minus 300, financing activities is 160. Net decrease is 60. It means cash decreased by 60 during the year. Opening cash is 100, and closing cash is 40. The direct method clearly shows where cash came from and where it went. The company generated 80 from operations, invested heavily in equipment, and financed part of that investment through borrowing. Remember, the direct and indirect methods will always produce the same final cash balance. They only differ in how operating cash flow is presented.